Well, hello everyone. Thank you for joining our monthly tax planning webinar. My name is Jamal Khan. I'm a senior tax partner at Churchill Tax Advisors. I've got with me my colleague Hazel Johnson and Alan Milne. Alan's having problems with his camera, so we can't see him, but Alan is there.
Yeah.
And today we're talking about the new tax changes or tax increases that have been announced in the recent budget. It's a very important topic because if you own a limited company, if you run a limited company, you need to be aware of these changes and how you can plan to minimize your tax outlay in the next couple of years. I'll let Hazel get started with this, and then we'll do a Q&A session towards the end. Hazel, over to you.
Okay, I'll just turn screen share on. And you should be able to see my slides.
Yes, we can see your slides.
Okay, so as Jamal says, we're going to talk about some of the recent tax changes in the budget. Not in any great detail, but to talk about what sort of future we think the tax landscape will be sort of set out as. And as the title says, tax increases. I mean, the direction of travel is only in one direction, and that is an increased tax burden, because as we're all aware, we have a pandemic to pay for. So about Churchill Tax Advisors, we're a specialist tax advisory firm based in London and Essex, but with national coverage. And we specialise in tax law, including income, business and inheritance tax planning. We also do tax investigations of all sorts, VAT and stamp duty planning, inheritance tax and capital gains tax planning, R&D, development tax credits, UK and offshore trusts and tax planning, and dealing with disclosure of undeclared income. And those are the details of our websites, both for the tax advising side and for tax investigations. So tax increases, what you should know now. So the agenda is going to talk about sort of the corporation tax and the proposed increase to 25%, and particularly in the context of associated companies and how that could affect marginal tax rates, but also the effect of capital gains tax, and there has been some discussion about wealth tax, so I will touch on that as well. So corporation tax is currently 19%, which is a very low rate as compared to many other jurisdictions. So Rishi has decided to increase the tax rate to 25%, but this isn't going to take effect until the 1st of April 2023, which gives us some opportunities to undertake tax planning. But against that, it must be said that there are no real details as to how this tax increase will be brought in. And that's particularly important in the context of what you can call taper relief or marginal rate relief, which previously applied to corporation tax when we had two different rates. We had a small companies rate and we had a main company rate. So the 19% rate will apply to profits up to £50,000. So anybody who's got less than that is going to is not going to have to worry about this. And then there's marginal relief for profits of up to 250,000. And so HMRC and the Treasury have estimated that 70% of companies will not be caught and they will be within the 19% rate. but previous experience suggests that it's a lot more complicated than that. So, you know, if you're hovering around the £50,000 profit mark, then you're going to have to consider what effect slipping into the marginal relief position is going to have, because you're going to face increases in tax that are well above paying 25%. You could have marginal rate that you're facing on an increase in profit of, say, sort of 50 or 60% because you've slipped into that higher rate tax bracket. And also what needs to be borne in mind is that the threshold, both the £50,000 and the £250,000 are reduced for what we call associated companies. So associated companies are very broadly companies that are under the same sort of ownership. And this is going to have an effect on structuring, I would say, because if you have two companies and your threshold is then £25,000, it's going to be a lot easier, obviously, to be hitting the higher rates of tax. And the difficulty of that is that, you know, frequently people who are sort of involved in, say, property investment have multiple companies. So it's quite common to have a development company and a property holding company, or you have a holding company with SPVs, so that you can sell sort of individual development projects. So what this means is that anybody who has more than one company and has a more complicated structure is very likely to be affected by these tax rates, because it's a lot easier to be earning £25,000 worth of profit than £50,000 worth of profit. So what this means, I would say, sort of over the next sort of 18 months, is that you should be reviewing structures over the next year to ensure that they are now going to be fit for purpose. So is it necessary to have as many companies as you've got? Can you rationalize your structure? It's just worthwhile sort of running as an eye over those structures to see if there's anything that you need to do to make them more effective for the future, and also to consider whether you can take profits early, whether you can delay costs so that you're sort of taking your profits earlier and having deductions against the higher rates of tax. You know, do you want to bring forward some of your projects to make sure that they are delivered and sold on before that new rate comes in? And sort of just generally checking to see if your structure is going to work under the new rules. If we also look at capital gains tax, it has been widely rumoured that capital gains tax rates are going to be made equal to income tax. Now, what set this off was that Rishi asked the Office of Tax Simplification to give a wide-ranging review of capital gains tax and to look at its sort of structural inequalities. And there are going to be winners and losers on this. So there's been pressure on entrepreneurs relief, but it looks like, say, employee management initiatives, tax share schemes are going to be made sort of broader and more applicable. So it's very difficult, I think, in the current climate to sort of anticipate which way a Tory government is going to jump. So it hasn't happened in this budget, but this review is still on the table as part of a wide-ranging reform of capital gains tax. And I think it's safe to assume, or it's prudent to assume, that capital gains tax rates could well go up, even if they don't reach the same rates as income. And that means that all the sort of structuring you do that is based on taking capital profits rather than income profits becomes pretty much redundant, because there's no actual tax differential between the two aspects. I mean, that's only a broad sort of analysis, because you may have capital gains tax losses that you've got brought forward, or it still may suit you to take a capital gain rather than income for other reasons. But generally speaking, that would be a wide-ranging change to the tax planning landscape. What this would mean is that it would become even more important to qualify for any CGT relief that's available. These traditionally benefit trading structures rather than investment structures. So if you have companies that are engaged in both, it may be worthwhile having a review and restructuring so that your trading and your investment holding assets are held in different structures. And, you know, there's a tension between that and your small company's rate being split between multiple entities. But if you're within your trading reliefs, it may be worthwhile thinking about. Again, you may want to think about bringing forward to disposal so that they take place before the next budget, which is probably going to be in this autumn. And it may be that, say, things like substantial shareholding exemption, the corporate reliefs become more important because you can use those to make disposals free of tax. And then, yes, you've got to face the next prospect of profit extraction from your company, but at least you can roll up your profits within that company at a reduced rate of tax. It's also the case that partnership planning may move more to the fore because you can make transfers within partnerships that are not subject to capital gains tax in a way that can offer you a lot of planning opportunities. Now, as I say, there's also been a lot of discussion about bringing in a wealth tax. There is, to some extent, I think, a compromise on the table in that people are talking about having a windfall tax on companies that have made a profit out of the pandemic. But more broadly, you may see some sort of review and reform to the inheritance tax system and or bringing in a wealth tax. Now, traditionally, these are sort of low in value, so you'd have a 5% wealth tax every year or even lower sometimes. And they're generally things that get sort of academic tax advisors, as it were, really excited because they think that this is sort of a very good thing. But in practice, they're very difficult to operate. And experience shows that every time a wealth tax is being brought in, it's either being sort of successfully evaded or basically people leave the country. So they're generally sort of unpopular with taxpayers for unsurprising reasons, but they're also difficult to administer because of the liquidity issues. So if your wealth is in land or your wealth is in stocks and shares that are unlisted, and you've got a 5% tax bill to pay for the year, it's going to be very difficult to find a way of doing that, and you may have to sort of resort to borrowing. And overall, I think it's thought that a wealth tax is not a very Tory thing to do. So again, I think, you know, the more traditional Tory MP may strongly resist the introduction of a wealth tax. But I think it is something to bear in mind as something that's sort of being mentioned and talked about with much more approval than it had been before. And we are certainly living in unparalleled times. So overall, in summary, although the change in the corporation tax rate from 19 to 25% is in many ways just a small change, because it doesn't change particularly the structure of corporation tax, it's just talking about a 5% increase. This could lead to a large change in structuring choices. So all of the structures that we've traditionally advised on and said was a good idea may no longer be the case. As I say, particularly on the basis of having multiple companies to deal with different projects or different land deals. So it's worthwhile reviewing or considering changes to your structures well in advance of that 1st of April deadline, and see if there's any restructuring that's required that will put you in the best possible position going forward. And I think, there's a general note that the future will be taxed much more heavily, so planning will become more important in the future. And this is something that is going to be sort of worth thinking about more frequently. So those are our contact details. Jamal is a chartered tax advisor and a fellow of ACCA, and I'm a tax barrister and lawyer. And those are the contact details of Churchill Tax Advisors.
Thank you. That's very useful. A couple of questions from the audience. One is, do you think these rates are here to stay?
What, the higher rates?
Yes.
Yes, I think
we've just exited the EU, and I thought we were going the other way. I thought we were going to go down, but we've gone up with tax rates.
I mean, I think so. I mean, I think it's going to be interesting because we have got a very, very large set of borrowing that we've got to pay off, and we have to find some way of doing it. And a lot is going to depend on how the economy does after the pandemic, whether it bounces back, whether it bounces back quickly. And I think we're going to have mixed bounce back. Some sectors are going to bounce back very strongly, some sectors are not going to. And I think we're going to have, unprecedented economic turmoil for about the next 2 or 3 years at least. And lots of changes that were coming, say, to the high street are going to be accelerated. So I think in the short to medium term, these tax rates are here. I think, it's generally Tory policy to reduce tax rates. So if the economy does well and it expands, then maybe we'll see some movement in reducing taxes. And if inward investment falls, maybe again we'll see some decreases or some tweaking around the edges. I think it's much more likely we'll get reliefs introduced rather than reducing tax rates.
Yeah. The second question I have there is, thank you for that, Hazel. That was useful. A lot of people who are thinking about transferring their property portfolio and putting into a limited company, that's not as attractive anymore, is it, with these new rates?
I think that's very, very likely to be the case. I mean, a lot is going to depend on what you want to do with that portfolio when it's in the company. So if you're looking to build your portfolio and you're looking to expand and roll up at a reduced tax rate is a better choice for you, then that still may be the best option. But then you still face that sting in the tail at the end when you're trying to take profits out of it, of getting your double taxation. And a partnership may give you better options at that point. I think, it's always going to be worthwhile having a look at the numbers on any particular fact pattern to see which is going to give you the better option. And so much does to turn on people's individual circumstances. Yeah,
I think a lot of people who were jumping into limited companies, you're absolutely right, they're going to have to think twice now. And what if the corporation tax rate goes even higher? Because it's the American rates, in America the rates are going higher. So with the capital gains tax, if that's down to about 40% in the US.
Well, and there's also this talk of sort of at the international tax level, and certainly I think the Americans are making noises about bringing in a minimum corporation tax rate that every country is going to have to sort of respect or see sort of difficulties with cross-border transactions. And although that's not necessarily going to affect a lot of our clients, the fact that you end up with a minimum corporation tax may do so. So I think there's a lot of pressure for tax rates to go up more broadly, so internationally as well as a result of the pandemic. And everybody's got to raise tax because everybody's faced the pandemic and everyone's got the same problems.
Yeah, well, exactly. We've got to get the money from somewhere. But I'm not sure if we should be giving a eat out to help out. I thought it was on the cards, but I'm not sure if it will still be on the cards.
We'll just have to wait and see. I think people are going to lift the lockdown. It's going to be a very cautious, sort of cautious 6 months. And I think in November we'll sort of have a better sense of where the economy is going. And then people will be making decisions. But I think, tax rates, the tax take is going to go up one way or the other. If rates don't go up, then the tax base will expand. And if the tax base doesn't expand, then rates will go up and it will just get that a little bit more expensive across the board.
Yeah. Well, you talk about November and I'm thinking whether November will bring a third wave or not. Hopefully not.
Well, yeah, that's always possible.
Yeah. Excellent. Well, thank you. I think if there's anybody got any more questions, they can get in contact with me. If you want to consider structuring your property portfolio or your company and how you're expanding, setting up new companies, do speak to us. And you can call us on 0207 998 1834, or if you've got my email, you can get in touch with the office and get my email. Thank you, Hazel, and thanks a lot.
Okay, bye-bye.
Thanks, bye.